Hello, and welcome to our first quarter 2019 strategy review. We met in this room on December the 20th, and joining us was Andy Leckel, who has joined us before. Andy is a money manager, independent money manager, and we'd really like to thank him. He added substantially to our meeting and again gives us some extra perspective. Also with me on my left, Bob Toomey, Vice President and Director of Research. On my far right, Nat Bowie, our paraplanner, and also added, I think, substantially to the international sector, as you'll see, and again gives us just more perspective. And then to my direct right is Len Skina. Len is our CEO, also Vice President. So with that, I'd like to segue into a presentation that I think will give you all a better idea of how our diversification works and why it protects you, especially during these trying times. So on your screen now, you will see a slide. And on the slide, you will see those 9 investment sectors that we deal with. And you'll see they go anywhere from short-term bonds out to including natural resources, real estate, etc. However, the one area that you usually hear about the most is the headline number, which is the mature U.S. stocks. And mature U.S. stocks during the recent quarter have been going down quite dramatically. They were down, as you can see, 13.6%. However, over a 3-year period, U.S. stocks actually were up 10%. Now, what I'd like to point out is we are always trying to reduce the volatility within the portfolio, and we do that by investing in not one, but in all 9. And all of you are invested in those 9 all the time. It just depends on what percentage you are invested in. Consequently, if we look at the 3-year period, you will see that the 10% return on U.S. stocks actually was the best return of the 9 sectors. However, all of them within that 3-year period were up, but again, U.S. stocks were up the best. Now, switching to the current quarter, again, U.S. stocks were down 13.6%. However, only developing U.S. stocks contributed a larger negative number. The other 7 sectors actually were either up or down substantially less. So when you look at that portfolio, you realize what we are trying to accomplish is reduced volatility. And while the 3 years might say, well, why didn't we just invest everything in the U.S. stocks? The answer is that would make your portfolio much too vulnerable and much too volatile. So the quarter gives you an indication of how much that reduction in volatility is accomplished through, again, investing through all 9 of the investment classes. Now, one last thing I'd like to point out is that we do also, within each one of the 9, make selections that we call tactical selections, and those are designed to try to improve performance over and above the indexes that we are looking at. Are we always right? Absolutely not. Nobody ever is. However, doing an attribution analysis, we found that of those selections, over 60% of them did better than their corresponding index. So, with that, we'd like to switch to our regular review and talk about the individual sectors that are represented by this chart. So with that, Bob, for U.S. equities.
Thanks a lot, Stan. So as Stan mentioned, clearly there's been quite a bit of turbulence, as we know, in the U.S. and the global stock markets. Through the end of, if you go back to the peak in September for the S&P 500, as of this morning, we're down about 17%. And I would want to put that in perspective. That is well within the normal realm of a correction, which we are normally considered to be a decline of 10 to 20%. We had a correction of this magnitude at the end of 2015, and we also had a correction of this magnitude, actually a little bit more, in 2011, the end of 2011. So it's not like this volatility or this type of market action is unusual. It's normal. These things happen periodically, and we have to keep that in perspective. Now, what are the concerns that are driving investors right now? There are a number of things, but I think most importantly, there's a concern about a slowing in the global economic growth. There has been concerns over Federal Reserve policy and continuing concerns over the so-called trade war with China. And those are valid concerns. But let me just say that while we think global growth is slowing, we think the U.S. economy remains very strong. It remains the strongest, we believe, of all the global economies. And we do not foresee a recession here in 2019. With respect to Fed policy, we do believe that the Fed is going to become less aggressive next year in raising interest rates. We strongly believe that they're really going to have to wait and see now. After they raise this rate here in December, they're going to have to wait and see what the long-term impact is of those interest rates. So I think really the market is revaluating for somewhat slower growth, but I believe to some extent it really is now overdone. It's really disconnecting from the underlying fundamentals for the United States corporate sector, which remain positive. I also want to comment on computer-driven trading. I was surprised to learn that computer-driven or algorithmic trading now makes up almost 80% of the daily trading that's going on in the exchanges. That is a huge amount of trading volume that really is not based on fundamentals. It's based purely on computer programs that are programmed to buy and sell at different levels of the market or on different news items that come out. So this is adding a significant amount of volatility to the market, and I think that also has to be taken into consideration. With those comments, I would like to turn it over to Nat to talk about international.
Thanks, Bob. On the international side, there's a lot of talk on the news lately. We continue to underweight it in international and no longer looking at emerging market. Even though emerging market offer a classic high-risk, high-reward investment opportunity, but the stocks are 50% more volatile than the U.S. equity. Secondly, the reason for us not getting back into emerging market is because of the slowdown of China economy, trade war, strong U.S. dollar, as well as higher interest rate. So therefore, we decided to focus more on the large developed IFA areas, which consists of Europe, Australia, and Far East. And with that, I'm going to pass over to Stan to talk about real estate.
Thanks, Nat. Yeah, real estate or the REIT portfolio that we've had virtually since the firm started. If you remember looking at the first quarter, the second best performance that was negative, but still not as negative as other parts of the equity markets, was real estate. We are, interestingly, continuing to favor the REITs because they continue to pay a very high dividend. However, a few quarters ago, we decided we wanted to avoid some of the shopping center overweighting in the general REIT population, and we bought medical properties. Interestingly, when we evaluate this particular quarter, medical properties actually was positive. So adding that tactical asset weight for medical properties in the REIT portfolio caused our REITs to basically outperform the REIT index. Although again, since the REIT index didn't perform, or I should say did perform better than most of the equity sectors, That gives you a good idea of how diversification and weighting work. So with that, I'd like to turn it over to Len to talk about the bond area, a very interesting area at this meeting. Len?
Thank you, Stan. The Fed has been on a mission lately to remove the accommodation that was put in place during the financial crisis in 2008 and 2009 and raise interest rates. They've done so 4 times already this year and 9 times in the last 36 months. But as Bob mentioned earlier, they're at a point where they're going to start slowing down. We don't anticipate any interest rate hikes for the next 6 months at least, and possibly even further out than that. We do anticipate some volatility in the stock market going forward due to geopolitical events and other things going on, and with a result of that, we do anticipate that there may be a flight to quality, which is something that occurs when there is volatility and people choose to invest in things that they consider to be safe. One of the things that they consider to be most safe is U.S. government bonds. And so we have decided to change from our allocation, which previously had been in completely corporate bonds, and we're now moving back into U.S. government bonds. The spread on those bonds, which is the amount of interest that each of them is paying, has narrowed. Usually corporates pay more, but they're paying only slightly more now than the governments. And with that spread narrowing, we've decided now is a good time to get back into the governments. We are maintaining a position in floating rate corporate bonds. And we do that because that has actually helped reduce the volatility of the overall bond portfolio during an environment where interest rates have gone up. While the Fed is going to slow down and perhaps even stop raising rates now, market forces still can affect interest rates. And we do anticipate that there may be a steepening of the yield curve at some point. With all of that going on, we feel that reducing volatility is a necessary thing and something that we'd like to pursue. So with all of that, I'd now like to turn it over to Bob to talk about the other changes in our model.
Great. Thanks so much, Len. So I think that was a great discussion, as Len just told you, about the rationale for changing our holdings in our bond portfolio. We had a very interesting and in-depth discussion about that. If I look at the one thing that we did do in the quarter at the meeting was we did do a deep dive review, attribution analysis of every holding in your portfolio. And I think that that was very important because we moved to simplify the holdings in the portfolio. We actually reduced about 5 or 6 positions in the portfolio, and I think streamlining is a good thing. We want to focus our holdings where we have the highest conviction. So in terms of the weightings and of the various ETFs that we are now investing in, we continue to overweight value, both in large cap US as well as international. We think that in the environment we're looking at with increased volatility, value stocks will hold up better because they are perceived to have stronger cash flows and higher dividends. And also, value stocks have underperformed relative to growth stocks over the past, really most of the last 9 years. And we think there may be a sea change going forward in which value outperforms growth. So we want to increase our weightings in that area. We did maintain our sector holdings in the healthcare and telecom sectors. We like those both because they have growth characteristics and they tend to be less volatile than the market overall. We did add a small position in gold, and the reason why we did that, going back to Len's comments about our concerns over increased volatility, gold tends to be a stabilizer or actually go up when we are going through periods of increased market volatility. So we felt that it was appropriate to add that position there. And overall, we reduced our weightings in equities slightly by about 3.5% within the model. Our bond exposure overall remains unchanged, and we continue to overweight shorter duration bonds within the overall portfolio and underweight long duration bonds. So with that, I will turn it over to Stan for closing comments.
Thanks, Bob. As you can see, we really had some very, very interesting discussions, and we did make some reasonably decent changes to the portfolio overall. I won't reiterate it, but the simplification, the adding to the gold, kind of represent our view towards reducing volatility, and that of course goes back to my first slide about reducing volatility through continued diversification. The other thing that we did, as we always do at the end, we did set triggers. Triggers, again, remember, are things we do not expect to happen, and I would refer to the trigger that we set at the last quarter where we talked about the 2-year Treasury bond and the 10-year Treasury bond crossing and what that would mean towards possibility of a recession. That did not happen. However, it is still a possibility, and it actually got closer. So we put that in again as an additional trigger. This quarter, again, we did not take any action on it because it didn't happen in the previous quarter. We also added another trigger as we talked a great deal about the Fed. And there's a lot of Fed talk, whether they're going to continue to raise rates. Of course, they just did raise rates the day before the meeting. But we felt it seemed they were acting in a more conciliatory fashion. So consequently, while we're not saying they won't raise rates further, we didn't think that they would raise rates as much as originally thought or as soon as originally thought. So the additional trigger we put in was if they raised rates in the first quarter, that would cause us to take action. That's what we're looking at. Again, thank you very much for tuning in this quarter. I always remind you that all of our previous videos are on our website, and we actually will have a brand new website which will hopefully, and it should look much better, and hopefully be even easier to use. So take advantage of it, and we'll see you next quarter.